It's years since the ECB has made such a move. March 2016 was the last time it cut both the refinancing rate and the marginal funding rate. For deposit rates, the last cut was back in September 2019.
Based on our updated assessment of the inflation outlook, the dynamics of underlying inflation and the strength of monetary policy transmission, it is now appropriate to moderate the degree of monetary policy restriction after 9 months of holding rates steady.
In March 2022, when the global economy was moving out of the COVID-19 pandemic and inflation was rising, the US Fed started raising rates. 4 months later, the ECB took action. The Fed is still deciding when it will cut rates. So, what were the reasons that led the ECB to make this decision? Between July 2022 and September 2023, the bank increased the rate by a total of 450 basis points. This helped reduce the Eurozone's inflation rate from 10.6 in October 2022 to 2.6 in May 2024. High interest rates in the Eurozone helped reduce demand and lower prices. As a result, the region's economy shrank by 0.1% in both the third and fourth quarters of 2023. This led to a technical recession, 2 consecutive quarters of contraction. But the first quarter of this year, it's been very different. The Eurozone economy growing by 0.3%. According to the estimates of the ECB, a 2% inflation target is not far away. Now it's more concerned about economic weakness. The bank lowered 3 main interest rates by 25 basis simultaneously. Following the rate cut, the 2024 GDP growth outlook has been revised up to 0.9%. ECB officials are not yet saying whether there could be more rate cuts ahead. Now it's over to the Fed to see if they will soon make a move. Betul Sare Altas, TRT World.
Well, let's bring in Russ Mould on this now. He's an investment director at AJ Bell and joins us live from London. Thanks for coming on, Russ. So what are the potential long-term impacts of the ECB's decision to cut borrowing costs on the euro area's economy?
Good morning, Emily. I mean, the intention is clearly to stimulate growth after a very, very weak 2023. The EU is already receiving some considerable benefit from lower oil and gas prices, which were a major problem for it 12 or 18 months ago, and also an easing in food price inflation. So they have already been positives for consumers. The lower debt, the lower cost of credit, the lower cost of debt is clearly designed to boost demand for credit and stimulate the economy. And interestingly, the ECB is actually raising its growth and its inflation forecast. So it does feel there are better times ahead. That also means, therefore, it may be taking a little bit of a risk, you could argue, by easing policy now when it's expecting growth to run stronger and inflation to run hotter than previously.
And Russ, we've got the parliamentary elections starting. How might these results impact Eurozone economies?
Yeah, I don't think they're going to be too. I guess it's going to be. I don't think it'll be too much of an economic issue. Although there is a sense that you will get potentially a move for the populist right, shall we say, which may make certain European countries have to consider some of their immigration or other economic policies. But I think President Christine Lagarde should be much more focused on inflation and growth than she will necessarily the parliamentary results.
And with the sort of higher than expected inflation rates in May, how do you think this will influence the ECB's future monetary policy decisions going forward?
That's a very good question. They did say that they use that word that's been peddled a lot in the UK and the United States as well, that the bank will be data dependent. They'll be looking at inflation, employment, wages, and other factors. The danger here, of course, is that data will be backward looking or at best concurrent, when what the European Central Bank is trying to do is set the cost of money for 18 or 24 months' time, because that is how long it takes the monetary mechanism to work. So they're effectively running the risk of driving the car looking in the rearview mirror. And that, of course, could mean that there's more of a chance of an accident or, in the case of this situation, a policy error.
Thank you so much for coming on today, Russ.
Thank you.